Hopefully you find this interesting. The market is really changing right now. It hasn't for about a year, but we're in a position now where it's really starting to change, so it's kind of exciting. So hopefully you guys get as excited about this as I do. I kind of get into it. If you do have questions, want to interrupt me at any point, just feel free to ask, stop me, clarify stuff. I go kind of fast. I'm from the East Coast, and we talk really fast back there, so everything, my brain's always going fast, and my mouth is going faster. So big news this week, CPI is coming down pretty aggressively. I don't know if you guys saw this, came out just yesterday. So overall and core both coming down pretty fast. What I think is interesting on this chart is how fast they're coming down. We know why they went up so fast. We spent, trillions and trillions of dollars, and we know why they're coming down, but it's coming down so fast. It actually is making me a little bit nervous how fast inflation's coming down. So look at that trend line, watch where that's going. It was supposed to kind of level off quite a bit, but it's not leveling off. It's coming down fast. So this will be interesting to watch. One thing that's important to understand in inflation, so as you're looking at this number, this is made up of a lot of stuff. It's made up of goods, services, housing. So you can kind of look, if you break those things apart, and actually housing makes up the biggest part of CPI, believe it or not. So housing is heavily weighted. So housing is still pretty highly, it hasn't come down as much, nearly as much as goods and services. So goods have come down quite a bit. Services is still kind of hovering high, but the cost of goods is actually coming down. That's what a lot of us think about when we think about CPI, is how much is stuff costing. The cost of stuff is actually coming down slightly, very little bit. A lot of people think, well, my groceries are still expensive. I haven't seen those costs come down. Well, that's not really, like when inflation slows down, costs don't usually come down. It just stays where they are and doesn't continue to grow as fast. We're not seeing eggs double in price, but the cost of eggs are never really gonna get cheaper. So that's the bad news. But we are seeing those costs for goods at least stabilize or slightly come down. But the cost of housing and everything else is still up. So, and one thing about housing to think about is a lot of housing is rental units. And so you think about rent, and even if rent is coming down, it takes a full year for the full effect of rents coming down to get baked into rental prices, because people are signing year-long leases. And so if you sign a year-long lease today and the rents go down tomorrow, you don't see that effect for a full year. So housing is kind of what they call a lagging indicator. So housing always comes down kind of slow. So if you kind of take that into effect, we do see inflation coming down really, really fast and really aggressively. What we're also seeing, the other big headline this week was the jobs report. So the jobs report came in significantly lower than expectations. And if you've heard me talk in the last 2 years, I have said that the Fed would not lower interest rates until they saw a weakening in the housing in the jobs market. And so we're really finally starting to see a little bit of weakening in the jobs market, especially as you look at unemployment rate starting to tick up a little bit. So we are actually starting to see a little weakening in the jobs data, which would be interesting. So other thing we saw, this is last week, kind of big news. I don't know if you saw Japan's stock market dropped 12% in a day, and then it actually went up 10% the next day. The US stock market completely crashed. It went down 1,000 points in a day. There's a lot of reasons for this, but this highlights how dependent we are on stuff happening all around the world that we're not always paying attention to. We didn't realize how much money was tied up in a trade between the Bank of Japan and US Treasuries, which is kind of what caused this. There were trillions of dollars tied up in that trade that needed to cover a hedge, so they ended up selling stocks. I mean, it's kind of this crazy thing that none of us were paying attention to. But the point is, there are a lot of risks in our economy and in the stock market that we're not paying attention to every day. So those are kind of the headlights. The other big thing we're watching is the 10-year Treasury, which is finally coming down. So this is all so there's a lot of good news in terms of mortgage rates that we're seeing happening in the news. This is another good sign. This is, we're going to watch this really closely, and I'll refer back to this, but this is important to understand. The 10-year Treasury got high, and now we're slowly coming back down. So what's going to happen? Where are we headed? So that's what's happened these last couple weeks. Question is, where are we headed? Does anybody know? This guy does. He actually does. One of us does. We just don't know what he's thinking. Before I tell you where he's headed, let me tell you what he did. So we saw interest rates. I don't know if I got a pointer. I can't really point. But so that black bar right there is where we are today. So we saw he raised the Fed fund rates higher and faster than they've ever been raised in modern history. So we've never seen anything like it. And what this does, this puts the brakes on the economy as hard as you can put them on. This is all the tools he has to put on the brakes. There's one other tool that we don't use, that would be cutting spending. So cutting spending and raising the interest rates are what slow the economy down. The federal government's been spending more and more money, significantly more. So we actually are in a period where we actually have the brakes on as hard as they can go on and the gas on as hard as they can go on. So the gas and the brakes are on at the same time. Right now it looks like the brakes are winning because things are starting to slow down. But since we have raised interest rates higher and faster than ever before and the brakes are on the economy, we're really starting to see the impact of that. It's taken a long time, but we're starting to see the impact. This predicts where the Fed funds rate is going to go. And the Fed funds rate is a little different than this. This is the 10-year treasury, which is highly correlated to the Fed funds rate, but not the same. So it responds to it, but it's not the same. The Fed funds rate today is actually at 5.5%. And that's really, it's kind of inside baseball, but it's basically what banks charge each other to borrow money overnight. But it does impact the 10-year treasury really dramatically. So when the Fed fund rate goes down, the 10-year treasury tends to go down, and vice versa if it goes up. So this is what economists right now, or what the market really is saying, the Fed is going to do with the Fed funds rate over the next year. This is over 1 year. So I think it's going to go from a little in between 5.25 and 5.5, all the way down to 300 basis points. So the 300, when it gets to 300, that's the point when the brakes kind of come off the economy. All the way from 500 to 300, the brakes are still on the economy, which is interesting. So this is kind of still slowing it down. And no one knows really when the brakes come off, but it's around there. So the market thinks we still have the brakes on the economy for a full year. So even if the Fed lowers interest rates in September by 25 or 50 basis points, the brakes are still on this economy in a big way. So, but we're going to watch that over the next year. You can see even a week ago that how far people thought the Fed was going to go down was different. And that changed because of some of these numbers. So the unemployment, payroll, and inflation have shifted where the market thinks rates are going to go. So they're actually a more aggressive thing, and rates are going to drop faster than they think. Now, having said that, you saw how quickly it shifted down. It can shift back up really fast. So that kind of goes up and down. And this, believe it or not, will really impact this. So where people think the Fed's going to go will really change rates today. So what's interesting about this number, this is already taking into account that the Fed is going to drop interest rates in September by 50 basis points. So that's already in this number. So if you think, oh, it's going to be exciting, hopefully they drop 50 basis points, we'll get a big reduction in mortgage prices, that's already baked in. Right? If he doesn't drop 50 basis points, rates will actually go up a little bit. So that's already baked in. Now, so let's talk about the 10-year treasury and mortgage rates, which I think is really interesting. So in the mortgage business, we are always looking at the 10-year treasury. We're always looking at it. We're always wondering what it is. We don't lend to the 10-year treasury, but the reason we care is because of that line right there. The green line is the 10-year treasury, and the blue line is mortgage-backed security rates. So the rate of mortgages is really, really highly correlated to the 10-year treasury. So that's why we're always watching it. That's why we care in the mortgage business what Jerome Powell is going to do, if he's going to lower or raise interest rates. All that kind of stuff really impacts mortgage rates. Now what's really interesting is the gap between those two numbers is about 170 basis points. So that's about the average gap over the last 10, 15, 20 years. It's about 170 basis points, so 1.7% higher. So a 10-year treasury is at 3.8, mortgage-backed security should be about 1.7% higher. However, in the last year, that spread got really big. That spread got as big as 300. So we saw 10-year treasuries at 4 or 4.5%. Mortgage rates were at 7.5%. So not 170 basis points higher, but 300 basis points higher. So not only are we dealing with a high 10-year treasury, that gap got really, really big. And that happens. You can see in history, kind of there's little spikes where it happens. So the good news, there's kind of good news, bad news. Bad news is we're at a big spread moment. The good news is, as things stabilize a little bit, that spread will come down. So that's one of the big hopes, is over the next few years, or next year even, that spread comes back to normal, down 100 basis points. So even if the 10-year didn't move at all, and the spread went to normal, we would drop 1 full point in mortgage rates today. So, which would be pretty exciting. So instead of a 6.5, we'd be at a 5.5, just to be at a normal spread. Now, there's a couple reasons the spread gets crazy, and that is anytime there's kind of anything a little uncertain, or they're unsure about what the market's going to do, or there's some volatility, if rates are going up and down really fast, the spread tends to get higher. And there's a few reasons for that. One, the 10-year treasury is the safest investment in the whole world, and so if people are nervous, they don't want to hold mortgages, they don't want to hold anything else except the 10-year treasuries. The 10-year gets a little cheaper and mortgage rates get a little higher. The other thing is if people are expecting rates to drop really fast, you also don't want to be holding a bunch of mortgage-backed securities. You know why? Because everybody refinances. And so all those mortgages you bought, all those mortgage-backed securities you bought, they pay you back early. You thought you had a 30-year stream of income, but you end up having a 6-month stream of income. Then you have to redeploy that money at a time when rates are a little bit lower. So, I mean, that's just kind of the inside of why that spread gets big. You don't really have to worry about it, but it is big right now. So, and it should get back to normal as the world stabilizes. So mortgage rates will come down again. It's the good news. Mortgage trend we are seeing, it's trending down, down, down. A couple other things that are happening though, while I shared some of the good news about CPI and all those things coming down, one of the weird things that's happening is people are spending more money historically than they have in the past. So we're still spending above where we should on the trend line. So we're spending too much money. Also, our savings rates are lower. So how are we spending more money, saving less? Where is that coming from? What's that? So, exactly. So really 3 big things. 3 big areas why we're spending more money. So number 1, credit card debt has never been higher. So we're borrowing. So we're borrow. Number 2, wages are growing really fast. So even though we're starting to see unemployment tick up, wages have been growing really fast. That's been happening. The third thing that a lot of people don't talk about is in the last 2 years, almost everybody who owned a home refinanced that home. And so there's a lot of money, whether it was through just a straight refinance or a cash out refinance, there was a ton of money that got redeployed back in the economy. And if you think about what happened to you personally, if you went from a 5.5% mortgage to a 2.5% mortgage, how much more money you have every month and where that money's going, almost everyone's just spending it. No one's saving it. So they're spending it and that's going back in the economy. So spending's high. And this is part of the reason why Jerome Powell kept interest rates so high for so long. And so what's interesting is we are seeing the economy start to slow, all those things slow down, but so far spending hasn't come down. So we can talk about why. This is one of the big reasons, because wage growth is still really high. So we see wage growth got really, really high in that 7-8% range, but now we're kind of in that 4 or 5% range. So wage growth is still high. And again, this is one of the big reasons why Jerome Powell did not want to start lowering interest rates, is because this wage growth was too high, and the only way to fix this wage growth from growing this high is for people to start losing jobs. So he was hoping the economy would start laying people off. Now this is the big balance, is how many people get laid off. Hopefully not too many. We can talk about that. I'm going to come back to that slide because that was interesting and I should have put it somewhere else. But another thing, this is kind of, again, getting a little inside baseball, but I think it's important to understand. Another thing that happens historically, there's a few times in our history where we get an inverted yield curve. You guys ever heard that term, the inverted yield curve? So we are currently in an inverted yield curve situation right now. And this is not good. And what this is when the 2-year or 6-month treasury has a higher rate, so has a higher percent than the 10-year treasury. So what that says, and that would never really be the case. Normally you'd think if I'm going to invest in something long-term over 10 years, I'm investing for so long, I want a higher rate of return because who knows what's going to happen over 10 years. And the 6-month treasury would be a lot lower because it's like, well, in 6 months I'm going to get such and such money back. But right now it's inverted. So they call it inverted yield curve. So the short term is higher than the long term. And what that says is the short term is riskier than the long term. So the market is saying short-term investments or short-term investment is riskier than long-term investment, which is kind of wild. So it's happened 7 or 8 times in history. So here they are. Here's all the times that it's happened. So you can look at all the different times it's happened. Today we got that black line below. And what this line is showing is when there's a yield curve inversion, how long until unemployment spikes and we go through a recession. And so we are now at a point we have not had that happen. Unemployment has not spiked and we're not in a recession. And so this is the big question. And you've heard a lot on the news about people saying we're going to have, this looks like it's going to be a soft landing. And still, I think 70% of economists think it's going to be a soft landing, which means we're not going to have a recession. So how do you go from every single time we have an inverted yield curve going through a recession to this time not having that happen? Yes? What's that? What's that? The yield curve inversion is narrowing. And they always go away. The yield curve inversion goes away. So this yield curve inversion will go away and it's narrowed. But the fact that it happened, and this is how many months after it happens and goes away, that actually the initial happening that you have unemployment. But the yield curve inversion is narrowing, which is good. But it happened and it happened really deep. So there's a few theories. One is this. This is federal spending. This is how much money the federal government is spending. And we're at levels like in World War II level spending. World War II was a period where we spent an inordinate amount of money to beat the Nazis. This go around, we're spending an inordinate amount of money for absolutely no reason at all. We're through the pandemic's over, all that's passed. What we found is that politicians become very popular when they spend a lot of money. And they've discovered that, so they're spending a ton of money. And that's our projection. So you can see where the projection is headed to where our spending is. And that is if we just continue spending at current levels and we don't add any new programs. So the projected spending is massive. We're spending on average $2 trillion extra a year than we bring in. So we're basically credit card spending $2 trillion a year. To put that in perspective, a million seconds ago was June 8th. A billion seconds ago was 1993, and a trillion seconds ago was 30,000 BC. So $1 trillion, this is the only thing that helps me understand how much a trillion is. A trillion is a lot of money. So we're spending $2 trillion a year extra that we don't bring in. As a result, what's happening, interest payments are exploding. The federal government is spending a huge amount of money on interest payments, which is really unsustainable at some level. But it's sustainable for a while. So we'll see how long this works. But it should be, we're not in real serious financial trouble as a country for 15 to 20 years at these levels. But in 15 to 20 years, we're in huge trouble. So the question is, will anyone address it in the interim? So far, no one's willing to. But this will be interesting as this plays out. But in terms of the economy and what's happening in the economy and why we're so charged and why things are going so well, even though we should be going into recession, this is a big part of the reason. Having said that, I still think there's a very good chance we enter recession. Either we are in a recession right now or entering a recession in the short term, because this graph doesn't lie, and the Fed has had interest rates so high for so long, and you remember that CPI number coming down, that is on a bad course. And if the Fed doesn't take the brakes off soon, I think we're going to see unemployment numbers really start to skyrocket. Also, if you take into account this, which is AI. AI is going to play a huge role in the next 3 years in terms of everyone's job and everything everyone does. And what's it going to do? It's going to make everyone in this room and everywhere more productive at their jobs. You're going to produce more by doing less work, which will be really good until we start to see some job losses, because you're so productive that we don't actually need 2 of you or 3 of you, we just need 2 of you. We don't need 10, we need 9. So those things are going to start to happen. It's interesting, I looked at some of the jobs data right now. I think last month, or maybe it was April, they thought 900 jobs in the US were lost due to AI. So pretty insignificant. So it's not happening yet. We're not seeing job losses due to AI. It may not happen this year, it may not happen next year, but at some point, we will start to see job losses, or the counter argument is we will be so productive and be so much wealthier and have so much that we will consume more, spend more, and we'll need more people to produce. So it's possible that that's another scenario. There's a lot of people that think that will happen. I tend to disagree. I tend to think this is going to happen so fast, and it's going to be so massive, and it will learn so quickly. They think most AI models, once they have it perfected, will start doubling their intelligence every 6 months. Once that happens, I think we will all be living in a new world, which would be interesting. So, but this would drive unemployment and other things up. So I think the Fed is really late on bringing interest rates down. I think they should have done it a long time ago, and I think they should be bringing interest rates down aggressively right now. But we'll see what they do in September. Okay, do we have questions on the economy? Yeah. I went through that pretty fast, sorry.
No, I really appreciate the information that you've been sharing about the fiscal situation, the debt. When the Fed started raising rates, we saw pretty quickly the banking sector start to see a lot of stress with failures, Signature Bank, Silicon Valley Bank, stuff like that. With the interest on the national debt reaching 75% of our tax revenue and whatnot, I guess my question is, what's your take on sort of the state of the economy? I mean, this is a lot of data, but how do you interpret it? And you said that we wouldn't be in financial trouble for 15 years. What makes you think that we have that?
So we are currently at a little over 100% debt to GDP. So our GDP, I think we're at like 30 trillion in debt, something like 32 trillion, and our GDP is 32 trillion. So we're like 100% debt to GDP ratio. Japan is 200% GDP to debt. So I don't know, I have no idea what their economy is, but let's say it's 8 trillion is their debt, or no, 15 trillion is their debt, and 7.5 trillion is their economy. So something like that. So they're at 200%, and they're starting to have some real issues. Japan is really going to have some issues over the next coming years because of their debt level and what's happening there. And so we'll kind of see how that plays out, because that will tell us how we're going to play out. So, but most people think that you don't really get into major trouble until you hit that 200% GDP point. It used to be 100%. Most people thought once you hit 100% GDP, debt to GDP, that was when the lights went out and things started falling apart. Whole bunch of countries that hit it, and they're all still doing fine. So now we've hit it, we're past it. Actually, I think we're probably 110, 115% at this point. So we've gone past it. We're still here. Economy's still roaring. The good news is this. So our GDP expectation and growth, now barring a recession, which I actually think could happen, but we are still stronger than almost any other developed country in the world. So the US is doing better. We have better demographics. We have better development. We have better education. I mean, all these things. Healthcare, we're one of the top in the world. So we have all these incredible things going for the US. Even though we've made some big mistakes, every other country is doing it and doing it worse. So we're all bad, but we're probably the least bad of everyone, is the good news. So the US economy will continue, I think, to be the strongest economy in the world. I think, even I don't know that China will ever catch us, even though they have a huge population advantage to us. I don't think they'll ever catch us in terms of GDP. I think the US will continue to lead the world, but we have real problems. It's just that everyone else's are worse, and so we'll still continue to shine. So, okay, yes?
So, from my real estate lens, my thoughts are if rates come crashing down, then the housing market's going to get psycho again.
Okay, I like it. Let's talk housing. So you want to talk housing?
Yeah.
Let's get into housing. Okay, we'll talk housing. So as we talk housing, a couple things to keep in mind. One, we're at a 28-year low in terms of number of houses sold, which is crazy considering how many more people we have in the country, how much we've grown. So it's really slow. So sorry for all you realtors out there. It sucked the last couple of years, and I'm really sorry. It's just been tough. Active listings is rebounding. So number of active listings is rebounding. But what's interesting on this graph that I think is really troubling is you look at active listings as rebounding, but that should be following the trend of new listings. So new listings is going down while active listings is going up. So what does that tell you? No one's buying. The market's getting kind of quiet. It's kind of quiet. So that's not, when those two kind of spread apart, that's not a great sign. The market's slowing down. Having said that, housing prices are going up, even accounting for inflation. So if you take out inflation, it's that lower gray bar. If you keep inflation in, it's that upper bar. Either way, housing prices are going up. So in this environment where interest rates, we have an interest rate shock. I mean, we didn't have interest rates go up, we had an interest rate shock. They went from 3.5% to 7.5% in a matter of months. That's an environment where housing prices should collapse, utterly collapse, but they didn't, they went up. So this is, the housing market is broken. Like, it is not working the way it's supposed to work. It didn't work, it hasn't really worked for a number of years, but right now it's completely broken because it's not doing what it should be doing. This happened in large part because of what happened at the beginning of COVID. Because at the beginning of COVID, the government borrowed and spent trillions of dollars, $6 trillion in fact, so talk how much a trillion is, it's a lot. So they borrowed and spent $6 trillion, that wasn't even in their budget. And part of what they did is buy mortgage-backed securities. So when they buy mortgage-backed securities, what happens to the mortgage rates? They got really low. So the mortgage rates didn't get that low just because the market said they should get that low. They got low because the government started buying mortgage-backed securities. They made up an artificial rate at 2.5%. And they thought this would be a great thing to pump, and really it was to pump money back in the economy, and it did. It pumped trillions of dollars back in the economy when they did that. What they didn't realize is how many people they were going to lock into their homes. They locked hundreds of thousands, millions of people into those homes at 2.5%, and it didn't really cross their mind that, oh, these people are never going to be able to sell these houses again. When you have a 2.5% mortgage, there's almost no scenario where it makes sense for you to sell that house, especially with rates at 7%. Maybe you rent it, do something else, just stay in it. Fix it up, do whatever. But there's very few scenarios when you have a 2.5% mortgage that it makes sense to sell it. Hey, if any of you that are trying to convince sellers to do it, I don't know, I feel bad, but it almost never makes sense because that 2.5% mortgage is such a valuable asset. It's a very valuable asset. So it's really gotten tricky. And this just shows we've lost hundreds of thousands of homes have been locked into place because the feds did that. Now, having said that, if rates get to 4.5% or 5%, the value of that 2.5% mortgage really starts to drop. It's much less valuable, and it will probably and likely unlock a lot of those homes. So it's not to say they're never going to sell, but when the rates are 6.5% or 7%, it's too big a gap. When the gap gets to 2 or 3 points, that becomes more enticing and more reasonable to say this. It's not, the value of that 2.5% mortgage is not as valuable anymore, and it may make sense to sell this house. So, but until that happens, it's become really hard. So why are prices going up? Because there's just not a lot of movement. There's not a lot of available inventory. I mean, even though inventory is even coming up, there's just not been a lot of movement, and we're in a kind of broken market. And the expectations are that we're going to continue to be this way for quite some time. The other thing that's happened is we've massively underbuilt since the Great Recession. So in that 2008 recession, when we had too many housing units, we've massively underbuilt both single-family and multifamily units. We're massively underbuilt as a country. And so even though listings are going up, everything's kind of going up, there's just still huge pent-up demand. So the demand side is still really high. Even though they're not buying houses at the rate they should be, the demand is still there. They're still looking, they're still going through. Right now they're not closing transactions, but I think they will be soon as we continue to see rates drop over the next few months. But right now we're just in this weird lull. Another thing that's kind of interesting for you real estate agents to pay attention to is happening out here on the buy-side commission. I get a lot of questions on this, on the NAR lawsuit, all that kind of stuff. So buy-side commissions, and this graph makes it look more dramatic than it is. It's only a 7 basis point drop. But buy-side commissions we are starting to see drop just a little bit, just barely start to drop. You guys know when the NAR lawsuit goes into effect? Saturday. Saturday. So we'll see what happens on the buy-side commission. We can talk about this if you're interested in it, but I honestly don't know if this is kind of where it's going to stay and it's just be buy-side commissions will drop a little bit, or if people really will start just going and trying to find homes on their own. I'm not, like, I could make an argument for either way, that people are going to continue to buy as they bought historically for the last 20 years and use a buyer's agent. And I can make an argument that a lot more people are going to go on their own and start looking. And I don't really know which one's going to win out, and maybe it's something in between. But I still think there's a huge demand for buyer's agent. Yes?
On the previous slide, do you know if there are any regions in the U.S. that have too much inventory?
Yes. There are regions that have too much inventory. West Virginia. Northern California, Detroit, there's certain pockets that have too much inventory. And mostly it's going to be states that are losing population. There's a handful of states that are losing population. Northern California is one, Southern California is gaining, Northern's losing, so California is net positive, but like West Virginia and some of those others have a lot of extra homes. So there are Arkansas and some, actually I don't think, I can't remember all the states, but there are definitely some pockets that have too much. So let's talk about Utah specifically. In terms of housing, what's happening in the housing market in Utah specifically. One thing that's important is we talked about those states that are losing. So here we go, Louisiana, New York, West Virginia, Illinois, Oregon, some of those states are losing population. Almost every other state in the union is gaining population, and Utah is one of the top, in terms of population growth, is one of the top. That fly likes me. It likes me a lot. Matt, I need you to come stand next to me and draw it away. So this is numbers from a year ago, but we saw that unemployment rate in the U.S. is at about 3.5%. It's actually about a little higher than that now. It's about 4% in the U.S. Unemployment in Utah has actually stayed pretty static at 2.5%. So if 3.5% is too low, 2.5% is way too low. But what's different about state unemployment versus federal unemployment, when federal unemployment gets too low, it becomes really hard to fix. That's when the feds need to raise interest rates, all that kind of stuff, because it's really hard to bring in a ton of employees to fill the number of jobs. When state unemployment gets low, what it means is it's going to drive in-migration. So when that gets real low, we're likely to see a lot of in-migration. However, we're also likely to see massive wage increases. So we're seeing big wage increases in Utah, and we're seeing a lot of people move in. So our economy here is really, really strong. Growing, and job growth rates, as you see, as a result, is higher than the national average. So Utah is a really strong market. As a result of the wage increases and people moving in the state, it's made Utah, this looks really crowded, but this is saying Utah is the 8th most expensive state in the entire country. So we are behind Hawaii, California, Washington, D.C., Massachusetts, Washington, Oregon, and Utah. Really incredible to see Utah in that top. We've historically been relatively mid or low. You can kind of see going back. We've been in a low housing price state, and we've now become a very high housing price state. Median sales in Utah, 2024, we actually saw a little bit of a correction in 2022, or in 2023 and 2022. Towards those end of those years, we actually did see a little correction in Utah. Pricing came down a little bit, and now we're headed back up. And I think one of the reasons, there are a handful of states that saw housing price corrections, and all of those states were the ones that saw 40 or 50% increases over a 2-year period. And Utah is one of them. Utah is one of the highest, fastest growth housing states in the country. It was an unsustainable rate, and the amount that we dropped was pretty minuscule, and you can kind of see we're almost back to the peaks of where we were. So, and we're likely to pass those peaks relatively soon. So housing prices just continue to go up, unfortunately. Affordable housing, so what percent of homes are affordable if you earn the median income? So if you are you earn the average income in Utah, what percent of homes can you afford to buy? It's about 15%. So really, really low. So it's very hard to find affordable housing in the state of Utah, even if you earn the average income. It's very, very difficult. Other thing that's happened in Utah is rents have gone up, but not dramatically, where housing prices have gone up very dramatically. So rental options right now make sense for a lot of Utahns, unless they're looking into the future of what's going to happen in the future and what could happen if you want home ownership. Housing prices are just going to get more expensive. Another thing that's happening in Utah that's very troubling, I think one of the worst things that's happening, so there's really only one fix for affordable housing. We saw what the feds tried to do to fix affordable housing. One of the ways, and they continue to do it, it's really interesting to see how many people try and fix affordable housing by lowering interest rates or manipulating mortgage rates. So if you lower interest rates or artificially lower mortgage rates, what happens to the price of, or the cost of housing? It stays pretty much the same, because housing prices just go up to match it. So it doesn't create affordability. And we saw a huge spike in housing prices, and then when rates go back up, because you can't keep them low forever, you've essentially priced everyone out. So you may have temporarily, for a few short months, created some affordable housing, but in the long run, you've destroyed affordable housing. So there's only one way. Do you have a question? Yeah, let's hear it.
How strongly correlated are the rent prices to the housing prices? Do you expect that to go into that?
Yeah, how strongly correlated is rent to housing? Traditionally, I mean, if you look at it historically, really close, right? People will choose apartments over housing when price of housing gets that high. So this is not sustainable. This can't stay that gap can't stay that big. Rents will either start to bump up to match it, hopefully not, that's the case, or housing prices will come down. And there's really only one way housing prices come down, and that's if we start to see some slight price drive, some slight mortgage corrections, or I'll tell you the real only way that pricing comes down. I'll tell you in a sec. Yes, Matt.
Why haven't rents already bumped up?
What? I don't know why rents haven't. Oh, I'll tell you why I think rents haven't bumped up in Utah, and that is we're building massive amounts of apartments right now. So that the construction boom in Utah has been massive. So we're seeing tons of apartments built in almost every community, huge amounts. Those will get absorbed, and I do think rents will start to tick back up. So having said that, right now we're in this little period where it's difficult to finance multifamily. So we're going to continue to see for maybe the next 6 months or so apartments get delivered, and then there's going to be like a 2 or 3 year gap where we don't almost see any apartments delivered because the financial market right now does not let you build apartments. If you go try and finance an apartment right now, it's very difficult. In fact, most banks won't lend you money almost at any rate, at any price to go build an apartment because banks are over leveraged. We talked a little bit about banks and the stress that's been put on banks. There's a huge amount of stress that's put on banks because of commercial lending. They are underwater on many of their commercial properties. Their rates are, and when those commercial properties have to refinance, those banks right now are kind of doing the pretend and extend thing where they're saying, hey, this property is so underwater, but will you continue to pay interest rates for the next 6 months? And then lenders usually say, or the borrowers usually say, yeah, I'll keep paying, I don't want to lose this property. So they're pretending that everything's all fine, and they're extending that deal, and that's happening over and over, but all these banks are worried about how much commercial debt they have on their books, so they don't want to write new paper for new apartments. So if you go to a bank right now and say, I want to build a 200-unit apartment, I need to borrow money, they'll say, oh yeah, we can do that at like 15%. It's like, so you don't really want my business. So it's really, so you're going to see a lot of projects not being built, so there will be a couple-year gap of a lot of apartments not getting built. Yes?
Actually, a follow-up question I had to my earlier question about the economy. What's your take on the banking sector's ability to weather this commercial real estate storm that they're facing?
What's the, yeah, I think, how are banks going to get out of the situation they're in? So banks, so I explained really briefly on what the banks, how much trouble they're in. If interest rates come down quickly and aggressively, I think the banks will be okay. If interest rates don't come down quickly and aggressively, banks are in a huge amount of trouble. The Fed does not want to see community banks or even large banks. The large banks, by the way, are fine. The big five, Wells Fargo, Chase, Bank of America, they are totally fine. They actually don't lend that much on real estate. It's the regional banks, the Zions banks and the smaller, like the Washington Fed, like those are the ones that will get nailed. Those are the ones that are all in trouble. The Fed does not want to see those banks go out of business. So they've been propping them up. You see that after the Silicon Valley Bank. The Fed actually pumped trillions of dollars into the banking community to kind of beef up their balance sheets. The Fed's going to do what they can to save the banks, and part of that is going to be lowering interest rates really quickly. So if interest rates stay high for a long period of time, these banks are in huge trouble. But if rates come down, these real estate properties start to make sense again, and I think I think they're going to find a way for these banks to weather. They won't all. There will be a few failures, but I think they're going to try really hard to help them weather the storm. Yes? On the digital dollar? Like on Bitcoin and that kind of stuff? You want to talk Bitcoin? I think the bank, there's a lot of people that will push really hard to make it seem like the economy is on the edge of collapse because it draws a lot of attention. It's really interesting. Our economy, we are borrowing way too much money. We have a lot of problems, but we're still the strongest economy in the world. There's no one that even comes close to us. The US dollar is the strongest currency in the world. Things are still relatively stable. AI could be very disruptive. That makes me nervous. But barring some huge disaster in AI, I think we are a really stable economy. I think digital currency is interesting. I think it's really volatile, which makes it really hard to use as a real backed currency. It's really hard to say we want to do or trade anything in Bitcoin because the value of it can go up and down so much. The nice thing about trading in dollars or yen or the euro or anything like that, it's really pretty stable. It might go up a couple percent or down, but that makes it very stable and makes people want to use it. I think digital currencies are always going to be risky until they stabilize and stop going up and down so much. I don't think people are going to want to use them for any transactions until they stabilize. So I think it's a little overplayed. I think there's a lot of doom and gloom out there. In the housing market, I would say the risk of like a real housing collapse or a housing disaster is close to zero. You think of what percent of properties in the US right now are underwater, and it's almost zero. There is a huge amount of equity in housing. 40% of housing markets don't even have mortgages on them. So people are not, there's no incentive for people like it was in 2008 for people to be underwater or be in false loans or any of these kind of things. So the housing market in the US is really strong, really stable. There's almost no fraud. The QM, the qualified mortgage, has eliminated a lot of the fraud and things that happened in 2008. So in terms of the housing market, I can speak to, feel very, very confident that it's going to continue to stay stable, probably continue to grow and get more expensive, especially as rates come down. Yes?
Would you say that Utah is above most states as far as strong housing?
In terms of housing, Utah is, yeah, we have one of the strongest housing markets because of not only, so I'll tell you why. So this is one of the things, this is one of the reasons why our housing market's going to be strong. So we've had some questions on affordability and how do we get more affordable. The only real way to become affordable is to build more housing units. So lowering interest rates doesn't create affordability long term. It may do it short term for a very short period of time, but eventually drives up prices. The only way is to build more housing units or build more affordable housing units. So if you had technological advances that made building less expensive, so you could do modular homes, those kind of things, smaller housing units or more housing units. So it all comes down to construction. That's the only way to build housing affordability. And so as you look at what's happening in Utah, these are the number of building permits we were pulling in the state. Went from 40,000 in 2021, and we can see this dropping pretty quickly. So yes. In industrial, has there been overbuilding in industrial? It's a really good question. I own a lot of industrial ground, so I hope not. So I might be biased. I would say the vacancies in industrial building are very low, kind of low single digits. And I think as the economy continues to shift towards more onshoring, bring a lot of manufacturing and warehousing to the US versus in China or other places, and as we become more dependent on online shopping and that kind of stuff, I think the demand for industrial continues to grow. We're seeing a lot of onshoring happen. A lot of it's going to happen, this will be interesting, but because of shipping. The risk of shipping across the seas is going to get riskier and riskier because of new technologies that are being deployed, new drone technology, all that kind of stuff that can sink ships, make them less likely. And if we look at some of the turmoil that's happening in the world, it'll be really interesting to see what happens in terms of China, if they end up invading Taiwan or other things. There's a lot of things that could happen that a lot of manufacturers want to bring as much back to the US or Mexico as they can because it's seen as much safer. So we're going to see a lot of onshoring, both to the US and to Mexico and Canada. Say, let's bring it as close to home as we can because the risk of manufacturing in China is too great. So I think we'll continue to see a lot happen in the industrial space. The other thing that's happening in industrial, the big, huge thing, again, going back to AI, is these data centers. These data centers are going to change all of our lives for the worse. So the amount of power they use, the data centers that are built in Utah right now, the request for the energy, purely just for the energy in Utah, is almost double what Utah currently uses right now. So data centers are eating huge amounts of energy. Now the problem is we have to win. The U.S. has to win this war on AI because if we don't, whoever gets it first, because remember I told you that it doubles in intelligence every 6 months, whoever gets it first is going to end up so far ahead of everybody else that no one will ever catch them. If you're doubling every 6 months and you get it 6 months early, by the time someone else catches you, you're twice as smart as they are. And then 6 months later, you're twice as smart, and they finally caught you. Well, now you're twice as smart, and it's an exponential growth. So there is a huge, huge race to be first, and that's why they're spending so much money on these data centers and all this kind of stuff. And it's it'll be interesting to see how this plays out over the next few years. But the amount of resources, power, water, land, industrial, that are being used by data centers is massive. Yes. We've gone off the rails a little bit. I apologize for those of you that are interested in this, but yeah. What? Say that question again. What would bolster it? Oh, the onshoring trend. Yeah, I mean, retail's been the big surprise over the last 2 years. I think a lot of people thought retail would be dead because of online shopping, all that kind of stuff. Retail's been really, really strong. It's been really good. I'm not sure if it's happening because of onshoring or just people. There's still a huge demand from Americans that we just like stuff now, not tomorrow. And I think retail just kind of it satisfies our mental disability. We can't wait for anything. We have very little patience. And so even when Amazon is sometimes delivering the same day, and it's not just that. Sometimes we like to try it on, we like to see it, we like to feel it, and we just want that experience. We want to have something to do. So retail's been actually surprisingly really solid in terms of an investment asset. I thought it was really going to suffer, and it hasn't. So I was wrong on retail. So it's been a really solid market. So having said that, if we say building more units is the only way to affordability, because we know rates don't work, Utah's in a world of hurt. We're not building more units. In fact, we're building less, and we have more people moving in the state. So housing in Utah is going to get more expensive. Housing is going to get wildly more expensive in Utah if rates come down, which I think is happening. So I think over the next few years, we are going to see affordability in Utah get significantly worse, not better. I think it's going to get harder and harder to afford housing in the state, and things just continue to get worse. And this shows another graph of where our construction trends are going. We were kind of meeting the trend to kind of meet, and this is still underwater for how many people are moving. Even at our peak, we were underwater for how many people are moving in the state. So we're still underwater, people are moving in, and you can kind of think of a trend line above that of how many people are moving in the state, which keeps going up, but our construction trend is going down. So we're building fewer units, we have lots of people moving in, we have low unemployment. All these things are kind of saying, hey, Utah housing needs to grow fast. It likely will. I do think technology is going to play a huge role. I think manufactured housing is going to play a huge role as we figure that out, how to make that more efficient and less expensive. Right now we haven't. We don't know how to make manufactured housing less expensive. It's slightly less, but not significantly less. But I think all these things, this is going to push it that direction. So I think housing will get less expensive. So Edge Homes, where's Edge Homes guys? I think they left. There they are. You got to figure it out. You got to tell us how to do it. But right now it doesn't make sense. Stick building is still cheaper. So it's just, but I think at some point, manufactured housing will catch up. Yeah.
So I'm from the Seattle area, and Seattle, California are doing ADUs where they allow you to condoize and sell off as a different tax parcel. Utah allows the ADUs, the data is here and there, but they don't allow the condo to sell off. Do you foresee that coming soon?
So the question is on ADUs. What's going to happen with Utah and the ADUs, and will we be allowed to condominiumize them, sell them off, all that kind of stuff? What I've seen, at least personally, is the ADUs not having a huge impact because the financing side and the construction side, all that kind of stuff, it's not super easy, and it's not always economically viable to build a condo in your backyard in terms of parking and what you're giving up, all that kind of stuff. I see ADUs playing a role in the fringes and having some impact. Even if you were allowed to sell them and condominiumize them and finance them, I see them playing a small role, but not a significant role. I think most people just don't want to have a house in their backyard or a condo or someone else living in there they don't know. So I think there'll be some. I think it'll help on the fridges for sure. And I think it'll continue to be something that we perfect and get better at. Again, a lot of those ADU units are manufactured, and they're not that cheap. They're very expensive. You look to price them out, and tough to finance. So the ADUs is not, I think, a great solution yet. It could become a great solution, but I think some of the solutions will be smaller housing units, significantly smaller housing units, significantly lower cost of construction, and improved technologies in terms of what land you can develop and how you develop, all that stuff, it has to happen. Otherwise, we're in a world of hurt. So we just are going to become unaffordable, and we will likely, and I think we will see a lot more people choose to rent over own. But having said that, there's still a huge amount of value in net worth. If you look at people who have created net worth in their life, the biggest area they've done it is in home ownership. And so it'd be a real shame for Americans not to be able to afford housing because they lose out on that opportunity to create real significant net worth. I think that's it. So, questions and answers. I'll start asking, you guys can answer.
What do you think about micro units?
What do I think about micro units is a good idea for Utah? I think there are some people that like them. If you've ever been in one, at my height, you don't like them. Or if you have as many kids as I have. But I think in terms of temporary or transitional housing, I think micro units can be really good. I think some of them are too small and kind of really cramped, but I do think there's a lot of people that's possibly a good fit. And so I think they'll play, again, a role in the fringes. I don't think it's not going to solve housing, but I think it can help on some of the fringes, for sure. Yeah.
So I want to shift gears a little bit to as the president of the Romney group. So my question is about risk, and bear with me because it's a little bit of a loaded question.
Yeah.
But I'm just curious, what is your relationship with risk, and what do you do to mitigate it? In terms of your acquisition with Intercap or other development projects, you've invested in almost every single asset class, and I'm sure a lot of that has been pretty risky. So I'm just curious, what is your thoughts about risk?
So what's my thought on risk? I took my biggest risk in my career in 2008, buying a big residential development, and lost. My net worth went to zero in about 3 months. From I was doing okay to zero in 3 months. And I was there for a year at zero and didn't feel very good. I didn't like how it felt. And I worked my guts off. I worked really hard. I came up with an innovative strategy to start buying apartment buildings. I bought 3,000 apartment units that I bought kind of one at a time, where I'd buy them, fix them up and flip them. And I was buying them in Oklahoma and Michigan and Indiana and these crazy places no one would want to go, and I bought them. And I put together a really big real estate portfolio over about 3 years when no one else was buying, and banks wouldn't even lend to me. I had to go borrow from friends and family and do it. Since then, I don't borrow money. So I'm like the opposite of every other real estate developer. And I've built a really big portfolio, and I've done really well. I've been really successful, but I'm so scared of debt, and I should borrow more than I do, but I don't like the feeling of being underwater on anything. And so I think the highest levered property I have is probably 20% leverage. And so I'm really low, and if I have land, I don't ever borrow money on land, ever, under any scenario, unless you're doing A&D. But on the raw land, you don't borrow money. On things that don't produce money, you don't borrow money, even if it looks like a great deal and you've got it turned in 6 months, it's going to take you 6 years, not 6 months. And so that's just been an investment philosophy I've had. I don't like risk. If I go, I can't, gambling is like the worst thing in the world, because if I go to Vegas and I win $100, I don't care, but if I lose $100, I think about it all day. And so it's like, it doesn't work for me. Anyway, so it's just, you have to learn who you are and what risk tolerance you have. My risk tolerance is very, very low, even though you think maybe it's high. I got lucky on a lot of things. I put myself in a good position. I worked really, really hard, but timing worked really well for me on a few things that I just lucked into. Timing on those apartments, timing on Intercap, on a few other things. I just got, I put myself in a position, I worked really hard, and then timing worked really well. And I think there's a lot of opportunity right now with AI that's about to come out. It's a really innovative and interesting, exciting time, but I don't know where to be. So, but I like owning stuff without debt. Yeah.
You said you went to zero in 2008, you said?
Yeah.
I'm curious if you could recreate that if you went to zero now, or if you were at the beginning of the journey.
Oh man, could I do it again?
What'd you say?
I couldn't do it again.
Yeah, what would you do? What would you do
If I was at zero right now? Oh man. I think I would focus on AI and AI tech. You look at, and I know you're a whole bunch of realtors and I shouldn't be telling you this, but stay in real estate. Keep sending Matt loans, right? By the way, Matt Barrett, and I just don't want to say this because I don't want to forget, is one of the smartest, hardest working humans I've ever met in my entire life. who is, if you have not sent him a loan, you have to send him a loan because it will change your career. He will help you in your real estate. He will help you in your life. He's an amazing human, and you really, really ought to work with him. So I was going to say at the end, but I don't want to forget. So, but if I had to start today, I mean, you look at, so here's what I think. Look at a company, look at some of these big technology companies, huge technology companies. So let's take, you know, whatever it is. I mean, I don't know, name a big technology company. Who's the biggest you could think of? Microsoft. So Microsoft developed these technologies that took them billions of dollars and decades to develop. These technologies can now be developed in a matter of months with almost no money. Tech companies are really going to have a challenge, and the margins for these tech companies are massive. What am I thinking? What's the? I'm trying to think of this company. Anyway, I can't think of the company. My mind's gone blank.
NVIDIA.
What?
NVIDIA.
No. NVIDIA. I'm thinking of the company, the big technology company that does all the phone stuff based in Chicago. What am I thinking?
Nokia.
Nokia. No, it's the software company. I'm blanking. Anyway, I'm blank. Anyway, but the point is, you can develop these technologies so cheaply and so quickly. And if you can develop a technology using AI that someone else has spent $1 billion creating, it's taken them 10 years, and you can offer it and develop that same technology, and you can't obviously copy it. That would be illegal, and you go to jail for that. But if you can create your own method of doing something that someone else has spent $1 billion doing and do it cheaper and faster and charge $1, or even better yet, charge nothing and just gather that person's data and know everything about them and then sell it, you could become a billionaire if you figure out what that is really quick. So that's going to happen. That will be happening, and you will see, I think, huge software companies that are going to try and do it. They'll try and beat you to it, so they're not stupid. They know this is happening. They're going to try and develop it. They're going to be ahead of the game. But it's going to be a Wild West environment where all these tech companies are going to have to replant their flag on what they own and what they've spent, where they have their money, and how many engineers they have, all that kind of stuff. So I think it's fascinating. I have no idea where to go or what to do. But I know there's something there. So, but I'm not smart enough to figure that out, and I don't want to start over. So I'm going to stay in real estate. I love real estate. I will say, in my career, I've met a lot of very wealthy people. 95% of them have been in real estate. So it's a really good business. So selling, buying, owning real estate is the safest business. And in terms of protecting yourself from AI, I think real estate is one of the few asset classes that's really going to be protected from some of the AI changes. So owning assets, selling, helping buy, all that kind of stuff is really protected. So I think real estate continues to be one of those industries that's very safe and very good. But I think in the next 5-10 years, our world as we know it's going to be very, very different. So I don't know if this helps. I went all over the map today, but part of it was most of it was your fault. I'm usually pretty good with my slides. You guys asked me some crazy questions. Yes?
Yeah, I think we all want to know, what is your projection or suggestion? No one knows, but
Yeah.
in the next 6 months, by the end of your rates,
Where are mortgage rates going to be in the next 6 months? I think rates, I don't know. Start with that. I have no idea. I think they'll be lower. I think in the next 6 months they'll be significantly lower. I think part of it depends on who the next president is. I'm not going to say who I'm voting for, who I care for. I do think Donald Trump is more likely to want to lower interest rates because he's a real estate guy, and I think he tends to do what's in his best interest first. So I would think that he'd be really aggressive in lowering interest rates. I think he would make a lot of money personally doing that. So I think now president can't lower interest rates, but he can put a lot of pressure and say things like he can't force Jerome Powell out. I think Jerome Powell's got another 2 years left in office, so he'll be there. But if the president's speaking every week and saying you need lower interest rates, lower interest rates, lower interest rates, I do think that has an impact on what the Fed president does. And right now, President Biden's been very neutral and not telling what to do. I do think there's probably a lot of pressure behind the scenes. President Biden wants interest rates lowered right now too. It's actually interesting. President Trump had a press conference where he said, if I get in there, I want to lower interest rates. I'm going to lower them fast. I'm going to lower aggressively. But I don't think Biden should do it right now. He should wait until after the election. So he knows what that would do to the economy. It would juice the economy in a big way. So I do think, I think either way, interest rates will be lower. I think they'll be more aggressively lowered under Trump. But I think rates, I hate to make a projection, but I think we'll probably see fives the next year, whether they're high fives or mid fives, I don't know. I think we'll probably see fives next year. But it probably won't be until next year. So I think most interest rate hikes for this year are already kind of baked in, and we're kind of seeing, what are you seeing in the 30-year today? Kind of mid-sixes, mid to low sixes. So we're going to have to see that spread. You remember the spread we talked about? The spread's going to continue to get narrower, and the 10-year is going to have to get a little bit lower. The 10-year has been really stuck at 3.8%. That 3.8 has kind of been a floor. We haven't seen it go below 3.8. If it breaks that 3.8% barrier, it really starts to drop faster. But it's been stuck at 3.8 for quite a while. Like, that's been the floor. It's danced with it a number of times, but it's been stuck there. So, okay, I think I've talked too long. You have one more question? All right, go ahead. One more question.
Do you have a daily reading list or
Do I have a daily reading list?
that stay up
Um,
on all this?
Yeah, I read something called The Daily Shot most days. I listen to the Housing Wire podcast. I read the Wall Street Journal, a lot of it. That's the kind of stuff I like to do. It's helpful. But yeah, I read the journal a lot. I look at it, read everything I can. So, okay, I went too long.
No, that was
Here we go.
perfect.
Appreciate it.
Give a round of applause.